MSTR posted a strong rally this week, and it wasn't just riding Bitcoin's momentum. Another major catalyst sent the stock up roughly 11% over the past 5 days, one that could fundamentally change how investors value MSTR and other companies holding digital assets on their balance sheets. The U.S. Treasury and IRS issued new guidance that allows corporations to ignore unrealized gains and losses on digital assets when calculating exposure to the 15% corporate alternative minimum tax. That might sound like legal fine print, but for a company like MSTR, whose balance sheet is heavily tied to Bitcoin, this is a big deal. Before this new rule, every time Bitcoin's price went up or down, MSTR's tax situation was complicated. Even if they didn't sell any Bitcoin, the simple change in price could make it look like they owed more taxes, just because their holdings were worth more on paper. Now, with the new guidance, that problem is gone. MSTR can hold its Bitcoin without worrying that normal price swings will trigger a surprise tax bill. In other words, their taxes are based on real profits, not temporary market moves. So if MSTR truly intends to hold its Bitcoin forever, as Michael Saylor has repeatedly stated, this new rule completely transforms their tax situation. Investors quickly understood what this meant. One big worry for MSTR is now gone. The company's huge Bitcoin stash is no longer a tax problem waiting to happen. That's why the stock went up, not solely because of Bitcoin or short-term trading, but because a major risk just disappeared. The market now sees MSTR as still volatile, but much safer from a tax point of view. This year has been a roller coaster for MSTR. Bitcoin's price has jumped up and down, the company has expanded its Bitcoin-related lending business, and it's raised more money to buy even more Bitcoin. Yet, the stock hasn't moved much overall this year. But if you look over the last 5 years, the story is different. MSTR investors have earned around 17% year-to-date in total return, still a solid result given how wild the ride has been. This new tax rule doesn't just benefit MSTR, it gives the entire sector a small dose of legitimacy. By allowing companies to hold digital assets without punitive tax consequences, regulators are signaling a gradual normalization of Bitcoin as a corporate asset class. For MSTR specifically, it means one less obstacle standing between the company and its long-term Bitcoin strategy. It also boosts confidence among investors who were previously wary of tax complications undermining the balance sheet. As always, MSTR's performance will remain closely tied to Bitcoin's trajectory. If Bitcoin rises, MSTR follows. The difference now is that the company's financial structure is cleaner, and investors can focus on fundamentals rather than hypothetical tax burdens. With regulatory pressure easing, tax clarity improving, and analyst price targets still sitting well above current levels, MSTR's risk-reward equation looks stronger than it did just a few weeks ago. And while it remains a volatile play, this time, volatility doesn't carry the same kind of downside risk it once did. So how does this news affect ETFs that are tied to MSTR's performance? Well, in simple terms, this is good news across the board. But how much it helps really depends on the type of strategy the ETF is using and what role MSTR plays in it. If the ETF is designed to capture MSTR's upside directly, then this policy shift is a big win. It gives those funds a cleaner path forward without the fear of unpredictable tax liabilities weighing on the underlying stock. For example, a fund that holds MSTR outright or tracks its movements closely could see stronger long-term performance simply because the market is now more confident in MSTR's balance sheet. Less uncertainty typically means a more stable price and potentially better compounding over time. But on the other hand, if the ETF is a covered call product, meaning it's built to generate high income by selling call options on MSTR, then its benefit is more limited. These ETFs still cap their upside, so even if MSTR rallies hard after this news, they'll only participate up to a certain point before that growth gets traded away for income. Funds like MSTY fall into this category. They can absolutely benefit from short-term rallies in MSTR, but the ceiling remains part of the design. That's why this kind of news serves as a reminder for investors to step back and think about what they actually own and why, because depending on your answer, this same piece of news means very different things. For growth-oriented investors, it's a fundamental improvement to MSTR's story. For income-oriented investors, it's still good, but it might not change your total returns as much as you'd hope, since your fund may only capture a slice of that upside. Ultimately, it comes down to alignment. Every investor has to make sure the ETF they choose fits their own financial goals and risk tolerance. This IRS change might be good for everyone holding MSTR exposure, but how good it is depends entirely on how your fund is built to use it. Overall, this was one big issue that was holding MSTR stock back, and now that it's lifted, maybe there can be a better path for MSTR stock going forward. If you found value in this breakdown, don't forget to like the video, subscribe for more deep dives like this, and let me know in the comments what you think about MSTR's future from here.